This is a video on Class 12 Accounts Chapter 13 Ratio Analysis, and today we are going to study about the fourth type of ratios, that is profitability ratio. So profitability is a measure of business efficiency. It is important because the business will understand what amount of capital it should have or maintain to expand the business or the enterprise. So the different types of ratios under profitability ratios are gross profit ratio, net profit ratio, operating ratio, operating profit ratio, earning per share, price earning ratio, and return on investment. In this part, we are going to learn about the gross profit ratio. So the gross profit ratio is a relationship between gross profit and revenue from operations, that is net sales, into 100. That means this profit is expressed as percentage. Now, how to find gross profit? So gross profit is equal to revenue from operation minus cost of revenue from operations. That means from sales or net sales will deduct the cost of goods sold. How to find the cost of revenue from operations or cost of goods sold? That is opening inventory plus net purchases, that is purchase minus purchase return, plus direct expenses minus closing inventory. There is another formula, that is cost of materials consumed plus purchases of stock in trade plus changes in inventories plus direct expenses. Now, what is this? What is the use of this gross profit ratio? It is generally used to fix the selling price so that the company knows or the business knows what amount of gross profit it should earn to cover the operating expenses or the fixed charges or the reserves which is kept separate. So what should be the amount of gross profit that the company or business should earn to fulfill this sort of expenses? Another point is it helps the business to find out the efficiency of trading activity. Now let us solve some questions from GK Goel. Question number 79A. Calculate gross profit ratio from the following figures. Opening inventory rupees 40,000, closing inventory rupees 60,000, purchases rupees 7,10,000, return outwards, that is purchase return rupees 10,000, wages rupees 80,000, cash revenue from operation rupees 3,45,000, credit revenue from operations rupees 6,30,000, return inward rupees 25,000. So first we'll find out the net revenue from operations, that is cash revenue from operations plus credit revenue from operations minus return inward or sales return. So the amount of cash revenue is 3,45,000 plus credit revenue is 6,30,000 minus sales return, that is 25,000. So the net sales is 9,50,000. Next we'll find out the cost of goods sold, that is equal to opening inventory plus net purchases plus wages minus closing inventory. So the opening inventory is 40,000. Net purchases, that means purchases minus purchase return, that is 7,10,000 minus 10,000 plus 80,000 of wages minus 60,000 of closing inventory, that is giving us rupees 7,60,000. So the formula for gross profit is net revenue from operations, that is net sales minus cost of goods sold, which is equals to 9,50,000 minus 7,60,000 is giving us 1,90,000. So the formula for gross profit ratio is equals to gross profit divided by net sales into 100. So 1,90,000 is the gross profit divided by 9,50,000 into 100, which is equals to 20%. Next, question number 82A. A company earns a gross profit of 25% on cost. Its credit revenue from operations are twice its cash revenue from operations. If the credit revenue from operations are rupees 8 lakh, calculate the gross profit ratio of the company. Here, the question is mentioning that the credit revenue from operations are twice as cash revenue. So can we write that the cash revenue from operation is equals to half of the credit revenue from operations? Therefore, we have done here, we have written 8 lakh divided by 2, that is rupees 4 lakh. So now the total revenue is equal to cash revenue plus credit revenue. So cash revenue is 4 lakh and credit revenue is rupees 8 lakh. So the total sales or the net sales we can say is rupees 12 lakh. Now the question is telling us that the gross profit is 25% on cost, but here no cost is mentioned. So let us assume that the cost is rupees 100. So what is the gross profit? 25% of 100, that is rupees 25. Then the sales is cost price plus profit, that is 100 plus 25 equals to rupees 125. Now from this sales amount, that is 12 lakh, we can find the cost of goods sold. We can find the gross profit. So we are following the unitary method. Like when sales is rupees 125, gross profit is rupees 25. When sales is rupees 12 lakh, gross profit is 25 divided by 125 into 12 lakh, that is equals to 2,40,000. Now putting it in the formula of gross profit ratio, that is equals to gross profit by net sales into 100. So gross profit is 2,40,000 divided by net sales is 12 lakh into 100. That is equals to 20%. Next question is question number 84. Here average inventory is rupees 60,000. Inventory turnover ratio is 5 times. Revenue from operations is 40% above cost. Calculate GP ratio. Now inventory turnover ratio formula is cost of revenue from operation, that is cost of goods sold, divided by average inventory. Now putting the above data in the formula, that is 5 equals to cost of revenue from operation divided by 60,000. Therefore the cost of revenue from operation is 60,000 into 5, that is rupees 3 lakh. Now revenue from operation, that means we are talking about the net sales, which is 40% above cost. So what is the cost price? Rupees 3 lakh. So my sales is 40% more than the cost price. So 3 lakh plus 40% of 3 lakh, which is 3 lakh plus 1,20,000 is 4,20,000. Now what is the gross profit amount? So gross profit is equals to revenue from operations minus cost of revenue from operation, that is sales 4,20,000 minus cost of goods sold, that is 3 lakh, is equals to rupees 1,20,000. So the gross profit ratio is equals to gross profit by net sales into 100. So gross profit is 1,20,000 divided by 4,20,000 into 100. That is equals to 28.57. That's all for this part. Thank you.